welcome to another episode of Economic Insights. I'm joined as always by Selim, a market veteran and the producer of our show. Selim, welcome back.
Good to be here, Alex, and I wish I were bringing better news.
That bad?
Bond markets don't lie, Alex. And this week, they had quite a lot to say. Let me walk you through how it unfolded, because the week had a very clear arc: optimism, a reality check, a brief recovery, and then a brutal finish. Early in the week, equities were holding up well, carried by the AI and semiconductor trade. But underneath that surface calm, the geopolitical pressure was already building. Trump rejected an Iranian ceasefire proposal outright, called it unacceptable. Oil moved higher. Bond markets started selling off as early inflation fears took hold. And in the UK, Keir Starmer was already fighting for his political life after disastrous local election results, with dozens of Labour MPs calling for him to step down.
So the mood was already fragile going into midweek.
Fragile is the right word. And then the US inflation data landed and made things considerably worse. Both CPI and PPI came in hotter than expected, reinforcing the view that inflation, driven heavily by the energy shock, is not going anywhere. Chip stocks sold off, Treasury yields jumped to multi-month highs, and markets briefly looked quite shaky. Kevin Walsh was confirmed as the new Fed chair right in the middle of all this. You cannot say that's a great first day in the office.
But then things recovered.
Briefly. Late in the week, the tech megacaps bounced back hard, powering the S&P 500 past 7,500 for the very first time. Retail sales data came in resilient. Cerebras Systems, an AI chipmaker, went public, and its shares surged nearly 70% on debut. AI enthusiasm is alive. Then all eyes shifted to Beijing, where Trump was sitting down with President Xi for the highly anticipated summit.
That was the big diplomatic event of the week. What actually came of it?
Considerably less than markets had hoped. The tone was cordial. China agreed to purchase 200 Boeing jets, which sounds meaningful until you consider that markets had been expecting something closer to 500. On the Strait of Hormuz, on Taiwan, on anything that would constitute a genuine diplomatic breakthrough, absolutely nothing. Trump returned from Beijing empty handed, which to me is a danger sign. Desperate men do stupid things.
And then the week ended badly.
It was ugly. Trump remarked that the US doesn't need the Strait of Hormuz to reopen at all. That single comment reignited fears of a prolonged global energy shock. Equities pulled back sharply. The S&P 500 posted its worst single session since March, and the bond market took a serious hit. The US 10-year Treasury yield pushed above 4.5%. Japan delivered its own shock. Producer prices came in with a massive upside surprise, and that pushed Japan's 30-year government bond yield to 4% for the first time in history. Think about that for a moment. A country that spent 3 decades trying to generate any inflation at all just saw its longest dated government bonds hit a yield level that has never been seen before. Global bond markets ended the week under significant stress, and that brings us to the inflation data in detail.
Let's go through developed markets properly then. US rates and bonds first.
The rate story in the US is a story of expectations dramatically repriced. Yields didn't just move, the entire forward curve shifted. The 30-year is above 5%. The money market curve has flipped from pricing cuts to pricing hikes by early 2027. That is a complete reversal of the rate narrative in a matter of weeks. And the inflation data tells you why. April consumer prices came in far hotter than expected. Headline inflation rose 0.6% in a single month, pushing the annual rate to 3.8%. Part of that was a strange one off quirk, a catch up to housing cost data missed during last October's government shutdown. This artificially inflated the shelter component this month. But set that aside, because even stripped of that technical adjustment, the picture was not clean. Energy prices were up over 3.5% in the month. Services inflation, the sticky kind, tied to wages and business costs, pushed further above 3% annually. And then the producer prices, what businesses pay before passing costs on to you, surged 1.4% in a single month, putting the annual rate at 6%. Businesses are not absorbing these costs. Margins on trade services hit a record high, meaning they are passing every cent through and then some. Transportation and warehousing costs jumped over 5%. The pipeline is full of inflation and it is heading downstream.
What does this mean for the Fed?
Analysts are now tracking core PCE, the Fed's preferred inflation measure, at somewhere between 3.2% and 3.4% annually for April. May is expected to be the peak, possibly reaching 4.1% on the headline. These are not numbers that give a central bank permission to ease. Kevin Warsh has said he views AI as a long-term disinflationary force, and he may well be right on the long view. But in the short run, AI investment is itself adding to inflation. Demand for computer components, semiconductors, and electricity is surging. The irony being that the thing everyone hopes will eventually bring prices down is currently pushing them up.
Let's head across the Atlantic and talk Europe.
Europe is caught in a difficult position. The energy shock hits harder there because the continent imports rather than produces energy. First quarter GDP held up, but the expectation is for two ECB rate hikes in 2026, most likely in June and later in the summer or autumn, to prevent energy inflation from embedding itself in wages and services. The interesting European story to watch is France, where the public deficit is heading toward 5.2% of GDP this year, and where presidential elections in April 2027 are starting to cast a shadow over fiscal credibility. Political risk is quietly being priced into French sovereign bonds. The UK we've covered in political terms, but let me give you the market numbers. 10-year gilt yields hit multi-year highs. The 30-year gilt yield has surged to levels not seen since the late 1990s. The currency has weakened. Markets are pricing a risk premium for holding British government debt, and it isn't small. The combination of higher gilt yields and weaker growth has already been estimated to have wiped around £12 billion off the government's fiscal headroom, and the leadership challenger hasn't even taken office yet.
Japan?
Japan had its own dramatic moment this week, as we mentioned. Producer prices came in nearly 5% higher year on year. The 10-year Japanese government bond yield hit its highest level since 1997, and the 30-year reached 4% for the first time in history, a genuinely remarkable milestone. The Bank of Japan is now widely expected to hike at its June meeting. The yen itself remains under pressure, despite the authorities spending an estimated 8 to 9 trillion yen on intervention since late April. It's buying time, but not reversing the underlying trend.
FX and commodities. Oil hasn't relented.
Oil has not relented and shows little sign of doing so. OECD commercial inventories are approaching stress levels, and analysts expect that even if the Strait of Hormuz reopens, the recovery in supply will be constrained by a lack of available tankers. The global fleet has been strained by rerouting and floating storage. The US is managing by releasing strategic reserves at a record pace and increasing exports. That insulates American consumers somewhat, but the rest of the world is fully exposed. In currencies, the dollar is better supported than many expected. Energy independence means the oil shock is less damaging to the US economy than elsewhere. The euro is under pressure, increasingly seen as a funding currency rather than a destination. Sterling is weak, for reasons we've discussed. The yen is weak despite massive intervention because the fundamentals haven't shifted. Gold attracted nearly $10 billion in net inflows this week. Central bank buying remains robust, and Asian demand for bars and coins is running 41% higher than a year ago. Copper inventories in China are at a 5-year low for this time of year. That's a supply signal worth watching.
Emerging markets. China first. Give us the full picture beyond the summit.
China's external numbers are extraordinary. First quarter GDP grew 5%. The external sector is firing on all cylinders. But internally, the picture is more complex. Credit growth slowed to a 19-month low. Households are net repaying loans rather than borrowing new ones. Long-term corporate lending contracted. The yuan is expected to appreciate towards 6.55 against the dollar by year end, supported by a massive external surplus.
India?
India is navigating the energy shock with a combination of policy interventions and fiscal discipline. April CPI came in at 3.5% year on year. The government has raised petrol and diesel prices for the first time in 4 years and sharply hiked import duties on gold and silver to slow the drain on the current account, which widened significantly in April. The trade deficit hit $28 billion, with oil imports alone surging 60%. The rupee is under pressure. The central bank's rate hike cycle has been pushed back to late this year or early next. The long-term story remains compelling, but the near term is absorbing some difficult headwinds.
Turkey. There was a notable inflation report.
Turkey delivered a significant upside surprise on inflation. April's CPI came in at 4.2% month on month, taking the annual rate to 32.4%. The central bank's response was revealing in what it said and what it chose not to say. It dramatically revised its inflation targets upward, some very large revisions. And in a further signal of how uncertain the outlook has become, the bank abandoned its traditional forecast range and shifted entirely to publishing single point forecasts. When a central bank stops publishing ranges, it is telling you something about its own confidence in the trajectory. The current account deficit widened to nearly $10 billion in March, the largest monthly shortfall in over 2 years. It was driven by goods imports rather than energy, which is the more worrying kind of deterioration. Capital outflows in March were substantial, with reserves falling by a record amount, but data points to partial recovery since then. The central bank's communication was careful not to signal imminent rate hikes. It described its current stance as sufficiently tight, but it explicitly retained the option to hike if conditions deteriorate further. Rate cuts, which had been expected earlier in the year, are now pushed to September at the earliest.
South Africa and Egypt?
South Africa is facing rising inflation, expected to peak around 4.7% to 5% in early 2027, and the central bank is expected to hike 25 basis points in May and again in July, defending its new 3% inflation target. The Constitutional Court revived the impeachment proceedings against President Ramaphosa this week, adding political noise. Foreign bond investors did return to South African bonds in April after record outflows in March, a constructive signal, but overall foreign ownership remains near historic lows. Egypt is in a more comfortable position. April inflation eased further to 14.9% annually. The central bank meets on the 26th and is widely expected to hold its policy rate at 19%, with a substantial real rate buffer nearly 5 percentage points above inflation. Egypt continues to attract yield-seeking investors despite the broader emerging market caution.
On Latin America briefly?
Brazil's central bank delivered a rate cut this week, but the forward guidance was cautious. The easing cycle may be paused sooner than anticipated, given mounting core services inflation and ongoing fiscal expansion ahead of elections. Mexico, meanwhile, has concluded its own easing cycle and is signaling an extended hold, having seen GDP contract 0.8% quarter on quarter in the first quarter.
What are we watching for the week ahead?
Monday brings China's April data dump: industrial production, retail sales, fixed asset investment, the full picture of what the domestic economy looked like last month. That will be important context for what we've been discussing about Chinese domestic demand. On Tuesday, Japan releases first quarter GDP. We also get the UK labour market report. Wednesday is the big day for UK with the April inflation data. Headline inflation is expected to fall sharply, but most of that drop is mechanical. Lower energy bills from the price cap reset, base effects. The number markets will be watching is services inflation. If that stays sticky above 3.5%, the Bank of England's problems don't disappear. They just get repackaged in a nicer headline number. Also, Wednesday, the Fed's April meeting minutes, critical reading for the detail behind those three hawkish dissents, and Nvidia reports earnings. After the week we've had in equities, that result will matter. Thursday brings flash PMIs across the US, UK, Japan, Germany, France, and the Eurozone. The first real read on whether May is shaping up any better than April. Spoiler, expectations are not high.
And keep watching the UK political situation. Quite the schedule. Selim, as always, thank you.
Always a pleasure, Alex.
That's it for this week's Economic Insights. Don't forget, folks, we do not give investment advice. For that, please consult a professional. Until next time.